All right, it is now noon in Lagos. Good morning or good afternoon, everyone. It's an absolute pleasure to welcome you all to this latest installation of the Coronation Securities Limited webinar series. I am Wale Famre. I'm delighted to be moderating today's session. Today's session is themed Mastering Market Volatility, how to optimize your investments amidst shifting interest rates, inflation, and global events. It promises to offer valuable insights into managing today's very dynamic financial and global landscape. No doubt, markets face growing uncertainty in today's, especially in today's context, especially in Nigeria, no doubt. And we look forward to unpacking this theme, and we have a very, very distinguished lineup of speakers and panelists who will be doing justice to this topic. So we look forward to having you join us and to share your thoughts. As you do so, I want to encourage you to use the Q&A field as opposed to the chat field so nothing gets lost. And no doubt we'll do our best to take all your questions and comments. All right, so without further ado, it's now my pleasure to introduce to deliver some opening remarks, Mr. Jibola Odenino, the CEO of Coronation Securities. He brings an extensive wealth of experience to the conversation today, and no doubt we are delighted to and appreciative of Coronation Securities' efforts to host this event. So it's over to you, Jibola. Yes, Jibola, you are muted. You're still muted. We can't hear you. You are still muted.
Let me try this.
Okay.
Okay. I think it just went to
success.
Default muting.
Over to you, sir.
Well, no, without a doubt, indeed. Wally, thank you very much. Distinguished guests. It gives me great pleasure to welcome you to today's event. I want to express my gratitude to all of you for accepting our invitation and taking the time out of your busy schedules to join us today. At Coronation Securities Limited, we're committed to fostering thought leadership and facilitating discussions that empower individuals and institutions and institutional investors across all segments of investor demography. Through our webinars, we aim to provide valuable insights and practical guidance for investing. It is therefore my great pleasure to welcome you to this edition of our webinar series themed Mastering Market Volatility, how to optimize your investments amidst shifting interest rates, inflation, and global events. In today's rapidly changing financial landscape, we are faced with significant market volatility, driven by fluctuating interest rates, rising inflation, and a host of global events. Understanding how to navigate these challenges is essential for both individual and institutional investors. During today's session, we will explore effective strategies for optimizing investments amidst those uncertainties, including risk assessment, opportunity identification, and decision-making techniques that can lead to financial resilience. We are privileged to have a distinguished lineup of speakers who will share their valuable insights and expertise with you this afternoon. Our keynote speaker is Odiri Ojini. She is Managing Director and Chief Executive Officer of United Capital Assets Management. Alongside Tony Odutola, the Deputy Chief Investment Officer at FCMB Pensions Limited. Ola Oladele is also on the panel today. She is founder of Money Weight Club, and complementing them is Chukwudi Nwao Keke. He is head of fixed income trading at Coronation Securities. A special thanks to our moderator, Wale Famurewa, anchor at CNBC Africa, and to all participants for your contribution to this important conversation. Your expertise and experience are truly invaluable, and I am delighted to have you all as part of this discussion. Whether you are a finance professional, an investor, or someone keen on understanding the intricacies of market behavior, this webinar will equip you with knowledge to make informed decisions and enhance your investment strategies. Once again, I extend my gratitude to each of you for joining us today. Your presence reflects your commitment to enhancing your understanding of market volatility and how to optimize your investments amidst a myriad of factors. I hope you find today's discussion both insightful and enriching. Thank you.
Thank you very much, Jibola, for those kind words and generous introductions. And as you mentioned, we look forward to being equipped with the knowledge we need to navigate very uncertain terrains. Someone said something many years ago to me that markets about volatility, they are intoxicating on their way up, but very devastating on their way down. So those who are able to read the market, so to speak, are the ones that win over the long term. So we look forward to getting that insight. All right, so without further ado, I would like to now introduce our keynote speaker. She's none other than Odire Ogini. She's the Managing Director of and CEO of United Capital Asset Management. With over 18 years of experience in the financial services industry, Odire has been instrumental in shaping the firm into what has now become a leader in the mutual funds industry and the largest fixed income manager in Nigeria, overseeing assets worth 1 trillion naira. So her leadership, industry expertise, and commitment to innovation have earned her numerous accolades and a reputation as a driving force, if I may say, in the investment management landscape here in Nigeria. So it's a pleasure to have Odire join us, and I will hand it over now to Odire to deliver her keynote presentation. So over to you, Odire.
All right, thank you very much, Wale, and good afternoon, everyone. Thank you, Coronation Securities, for having me. It's an honor to be here to make this presentation. So briefly, I'll be sharing my slide in a moment, and just please let me know if you can see my slide.
Yes, we can. Please go ahead.
All right, thank you very much. So I've been tasked with the privilege and opportunity to speak on the topic mastering market volatility, how to optimize your investments amidst shifting interest rate, inflation, and global events. And I think everyone can agree that this year, it's a year of massive volatility and being able to navigate. I think the word I always use is being able to navigate volatility, is critical, whether you're a fund manager, you're a corporate treasurer, you are managing investment in your own personal capacity, or you're managing an event for, a wide array of clients and other investors. It's critical to learn how to manage volatility because markets will always be filled with volatility. So yeah, we're just here to share our thoughts on how we see the market. I will be starting out with looking at some of the key variables and indicators in the global market as well as in the domestic market. We also be looking at insights into the financial market landscape, both money market, capital markets, and basically how we can use that to build a very robust asset allocation, so we are not concentrated in a particular instrument or in a particular part of the market. And then we'll now look at, some of the strategies, and ways that we can, navigate this very interesting terrain that we find ourselves. So moving on to global market, I will start with some of the key indicators in the global market and some that largely we are familiar with, but not just being able to understand and know these indicators is also important and critical for us to be able to know how they also impact us in our various portfolios that we manage or we have oversight over. From a global perspective, the global economic growth has remained resilient in 2014. We've seen growth across the US markets. The US economy grew by 3.1% in Q2, which is higher than 2.4% year-on-year growth in 2023. We've also seen growth in the Europe market. GDP rose by 0.6% year on year. Also in other markets such as the UK, we've seen growth surge higher to 0.9% year on year in Q2 2024, which is largely the biggest annual growth rate since Q3 2023. In terms of inflation, we've seen global inflation remain high in 2024, and this is largely as a result of rising food price as well as rising energy cost. The global central bank continues to fight inflation, with looking at ways of bringing inflation down to their target of about 2%. Although we've seen headline inflation moderate in the US, is currently at 2.5% year on year in August, which is the lowest so far they've seen since February 2021. Slightly after COVID, or still in the midst of COVID. In the Eurozone, inflation is currently at 2.2% year on year, which is also one of the lowest they've seen for almost about 3 years. In the UK, we've seen price pressure remain sticky, so inflation is still largely unchanged in the last 2 months. For interest rate also, we've seen on the back of being able to fight inflation, we've seen rate cuts across these various markets. In the US, we've seen the Fed cut rate by about 50 basis points. In the Eurozone, we've also seen a stability. In Europe, we've seen central bank cut the benchmark interest rate also slightly on the back of being able to manage inflation. So basically what we are seeing is that not just domestically, we've seen in the global market, there is moderate economic growth, but there is significant impact on inflation and interest rate, and the ability to be able to manage inflation significantly also does still to how the interest rate also pans out. In the domestic market, the story is not significantly different. It's not that far from what we've seen in the global market. In terms of economic growth, Nigeria's real GDP grew by 3.1% year on year in real terms in quarter 2 of 2024. This growth is higher than what we saw recorded in the same period of Q2 2023, and also higher in terms of growth rate in Q1 2024. Inflation is a major nightmare that we all know in Nigeria today. Even though between July and August, we saw inflation print lower from 33.4% to 32.15%, but you all agree with me with what we see around rising price of fuel, that this inflation figure will probably even go higher, relative to what we saw in August. Interest rates is also a key indicator that's being tracked here, because it also impacts largely on our portfolio. At the last MPC, we see rate increase by about 50 basis points from 26.75% to 27.25% in September 2024. Year to date, we've seen rate increase by about 850 basis points. I know at the last MPC, the outlook in the market really was that they will hold the rate, or maybe at best, on a positive note, we'll see a rate decrease. But to everyone's surprise, or at least the majority of the analysts in the market, to our surprise, there was a rate increase by about 50 basis points. And this all alludes to the fact that, inflation is projected to increase in the coming months on the back of increase in fuel price. And we saw that increase, pan out yesterday, with fuel price trading at almost over 8,000, depending on the location that you're looking at. For FX, which is also a major issue, that we are dealing with in Nigeria today, FX rate at 1,700 naira to $1, between 1.5 and almost 1.7, both in the official market and the parallel market. We started this year with FX around 1,000 naira to $1, or slightly below that. Today we are pushing almost close to 1.7 or even 1.8. With no real despite the policies that are being put in place, and initiative of the central bank to curb this volatility and also boost dollar supply, we can, attest to the fact that, dollar supply is still a major issue. About a month ago or so, the federal government raised about $900 million from the Eurobond domestic market. That is still a very tiny fraction relative to the level of supply that is needed to be able to ensure that there is stability in the FX market. We also see external reserve increase year to date by 14.8%, but that's still not sufficient and not strong enough, to be able to support, the foreign exchange in the market today. So these are key parameters and indicators that, to a large extent, track the way we look at and the way we manage our portfolios, both on a personal note and on a corporate level. There are also other geopolitical events that definitely, will impact us on a domestic front, because the market to a large extent is already interconnected. So a lot of these factors we need to pay attention to, as we look at our investment, as we try to navigate this very interesting terrain. Now, moving on to overview of the financial market. I know this might look like a very basic insight, but I think it's very critical for us because, in our market today, a lot of us are more short-term in our investment outlook. We play largely in the money market, and we tell ourselves that we're investing, but the financial market landscape is much more than a money market landscape. It's both a money market and a capital market. It's both short-term and long-term. And so the ability to be able to diversify our portfolio from both short-term or have a robust portfolio that takes into consideration both the short-term, instruments as well as the long-term instrument gives us a well-rounded capacity to be able to navigate and deal with volatility as they arise. So the financial market is made up of the money market as well as the capital market. The money market basically focuses on short-term borrowing and lending, both for institutions as well as for government. And we have instruments such as money markets, instruments such as treasury bills, commercial paper, certificate of deposit, and things like that we categorize under the money market segment of the market. On the capital market side, which is basically a long-term market and focus on long-term instruments, we have the debt capital market as well as the equity capital market. The debt capital market is basically a market for trading fixed income securities and long-term debt securities. The instruments here, we're looking at the FGN securities or FGN bonds. We're looking at state bonds, corporate bonds, and also other sovereign type of bonds. The debt markets are basically used by both companies and sovereign institutions to be able to generate and obtain long-term funding. So funding above 1 year. It could be 3 year, 5 year, 7 year, or even as long as 20 year. Instrument. The equity capital market is an organized market where we have shares of companies that are listed on it. A share basically represents ownership of a company, and so it entitles the owner to some of the benefits of the company, both at the present level and also in the future. Now, just basically looking at some of the instruments that we have between the capital market and the money market. The capital market is basically for long-tenured instruments. So you have things like bonds, long-term bonds above 1 year. You have federal government bonds. You have corporate bonds. You have bonds issued by any entity beyond whether they're corporate or sovereign. You also have the equities. The interesting thing about the capital market is that you have capacity to earn higher return. But because of the long-term nature of the instrument, you also expose yourself to significant risk. You're also exposed to the risk of default. So it's possible that these entities or institutions who come to the market to raise these instruments may not have the capacity probably later on to be able to repay. So there is a risk of default. For the equities market, the shares are traded on the NGX platform, and they are subject to market volatility. So a lot of the time, when we look at volatility, not just on the fixed income side or the interest rate side. We also look at market volatility, where prices are traded and they go either up or down. And so the direction of the interest rate environment also impacts significantly on the equities capital markets, because there is an inverse relationship. Because the fixed income market is perceived to be lesser risk than the equities markets, when the fixed income market is probably offering a much higher return, like it's currently obtainable now, people tend to shy away from the equities market because of the higher risk it's exposed to. For the fixed income instruments or debt instruments, there are interest payment that is done every 6 months and is at a fixed rate. So corporates are entitled to pay interest on every 6 months on the instruments that they have issued. For equities, the corporates pay dividends or they issue bonus shares. And so investors also tend to enjoy capital appreciation. So long-term instruments are also traded. So you can invest in any of the debt instruments, either from sovereign or corporate, as long as they are listed, it can be traded also on the various market exchanges and platforms. I talked about the fact that the instruments include FGN instruments. They also include Sukuk bonds, could be part of these corporate bonds and things like that. For money market instruments, which are basically short-term instruments, relatively 1 year or less than 1 year, you have the Treasury bill. Today we have 90-day, 180-day, 365-day Treasury bill. We have commercial papers in the same range, but basically less than 1 year. And so these instruments are also relatively liquid. And so a lot of investors tend to turn towards money market or short-term instruments because, they have access to their money whenever they need them within a short period of time, relative to holding, some of these instruments, for a 1 year period and above. Now, just to be more specific on some of the money market instruments, Treasury bills are issued by the Central Bank of Nigeria. They are perceived to be low risk. They are short-term instruments, but they also perceived to be low risk. Sometimes I just joke with them and say, why do you think that Treasury bills or government securities are low risk? And in my own estimation, the fact that they can print the naira or they can print money, means that if there's that tendency to default, probably they can fall back to their capacity or their function of printing money, but they are perceived to be low risk simply because they are issued by the government. We have maturities ranging between 91 days to 364 days. And within our market today, despite the fact that there is significant volatility, we see the Treasury bill rate, significantly high and very competitive. At the last auction yesterday, even though 1 year Treasury bill traded or printed lower than what it was, but to be earning over 20% on a particular instrument, which is risk-free, is significant in a market like this. And I think the goal really is, despite the fact that inflation is really high, there is a need to encourage investors to spend less, and invest more. So one of the advantages of Treasury bills is that they are risk-free and they are highly liquid, which makes them very attractive for conservative investors who, are not very familiar with risk. They can play very safe with the Treasury bill market. But the yields are based on inflation and monetary policy, but they often provide competitive return relative to inflation. And basically, even though the rates in the market today for Treasury bills are relatively high, it's still far below what we have for inflation. We also have commercial papers, which are basically issued by corporate entities. They are short-term. They are also unsecured promissory notes. They are issued by companies, basically to finance their working capital, also, refinance some other project that they're working on. These companies are usually large, credit-worthy corporations, but they're also subject to certain level of risk. And so the risk for commercial paper is relatively higher than the risk in Treasury bills, because these corporate entities can default in paying that, even though we've not seen that in the market, but it's also a risk that plays out in that particular instrument. For money market fund, which is basically a pool of fund or an investment vehicle that is created to invest in instruments such as Treasury bills and commercial paper, they also still enjoy the benefit of having a higher yield relative to their underlying instrument and what they are currently earning. They offer daily liquidity and stable return, and they are basically stable for investors who are looking for safe and liquid instruments. And for investors who are looking for a relatively short period of time, maybe less than 30 days, call placements and things like that, the money market mutual funds also provide that level of opportunities for them. It provides diversification, free entry, free exit, liquidity, for short-term investors and investors looking for safe instrument. And then you have the fixed deposit, which is basically, a term deposit offered by institutions, asset managers, or banks, that probably offer fixed rates, but also provide safety, for the investors, but they are usually less liquid compared to the other instrument, which can really be traded, in the market. Now, for the market that we basically operate, we've seen a lot of investors are more short-term in their investment outlook, and it's largely because of the level of uncertainty, that we have in our markets. For capital market instruments, we basically have the equities or shares. Investors can easily buy shares of publicly listed companies on the NGX, and these shares or equities basically represent a percentage of ownership in that company, and investors can earn both capital appreciation and dividend. And we can see that Last year, the equities market did over 40%, which was really far above what inflation printed at about 24, 25%. This year, we've seen the equities market also return an average of about 30%, even though it's still slightly below what inflation is printing out of about 33, 32%, but relative to what the other perceived low-risk instruments such as treasury bills, commercial people are doing, we can still say that the equities market is probably returning much better, than the other short-term instrument. However, it is subject to much higher level of risk, relative to the other risk-free or lower risk instruments. For bonds, we have the FGM bonds. These are long-term debt instruments issued by the federal government to fund projects. They are also considered risk-free in the nature of the fact that they are issued by sovereign, but based on what we've seen in Ghana today, sovereign can also default, maybe not their local instruments, but also they can also default. So they are, for local instruments, they are still relatively considered risk-free. FGM bonds today offer periodic coupon payments. We have FGM instruments 3-year, 5-year, 7-year, even as far as 20-year bond. Coupon is paid every 6 months. And this year we've seen FGN instruments trade at about 20, 21%. So what that means is that investors are able to, lock those high interest for a much longer period of time, and so, this is one way for us to even take advantage of the volatility that we see, because yes, interest rates are high today, government is paying more, just to borrow money from the public, but it may not be sustainable, so there is issue around the sustainability. So even though it's not sustainable, the goal for us, even as asset managers or as investors, is to see how do we diversify our portfolio beyond the short-term treasury bill, CP, fixed deposit, and the likes, to much longer-term instruments that are relatively safer. Maybe not equities, but bonds that are relatively safer, and are currently offering much higher return for investors. And investors can lock in, imagine locking 20, 21% for a period of 5 years or 7 years, or even much longer than that. We also have state government bonds, which are basically issued by states in Nigeria. We also have corporate bonds, are also debt instruments issued by corporates to raise capital for expansion, and they follow the same dynamics of coupon paid every 6 months. Rates of investment is fixed. So as these instruments come out, depending on their level of risk profile, investors can take advantage of it and lock those high return for a much longer period of time. We also have other capital market instruments that are long-term in nature, such as the exchange-traded funds and real estate investment trusts. But I think, from a capital market perspective and from a long-term instrument perspective, and as an investor, there is a need for us to begin to shift our focus from just, short-term instruments to begin to play around looking at long-term capital market instruments and how we can also lock in our return for a much longer period of time, rather than playing alone or largely solely in the money market space. So what are those strategies that we can adopt to be able to manage and navigate the investment challenges in a volatile market like we currently play in? The first is to diversify our portfolio, and the reason why I decided to share on the scope of the financial market is basically to see how within the financial market, what are the available instruments, what are the available opportunities that one can play in and also diversify. So being able to...
I think we may have lost contact with Audrey. Hopefully she would be able to reconnect with us. It's part of the challenges we have in Nigeria these days. The infrastructure can be a little uncertain. So it's like volatility. There's volatility in infrastructure in Nigeria as well. I'm sure many of us would agree. All right. So I think I do believe she is.
Sorry.
Yes.
At what point did I didn't know I was just talking?
Maybe just about a minute. So it wasn't that long.
All right.
So
just let me know.
You are sharing your thoughts on what to do in the context.
Specifically diversification.
So you started with diversification.
All right. Sorry about that. So I was talking about diversifying.
Like I was telling the audience, there's volatility in infrastructure. especially in
Wow,
Nigeria.
that's true. That's true.
But
So I was talking about
go ahead, please.
All right, thank you. So I was talking about diversifying our portfolio across asset classes, also across geography. That even though we play in a world or in a market where there is so much connection, and events in other markets can largely spill into our own domestic market, but it's also important for us to be able to diversify and reduce the risk of, a localized investment markets. Also, we also have sector diversification, invest in various industries to be able to balance gains. So there are industries or there are sectors that are basically defensive. They are able to withstand shocks, irrespective of the cycle, in the market, they're able to withstand. So sector diversification is also critical. So basically diversification helps to cushion the impact of, market downtimes, as we are saying, as different assets often react differently to market conditions. So today we see in the fixed income space, with the rising interest rate, investors are benefiting from a high interest rate environment. However, on the equities market side, we are seeing investors switching, from that particular market because, it's high risk, but I can also invest in a low risk environment or instrument and hence a higher return. So basically, diversifying our portfolio is critical in a market like this to be able to help us reduce and manage our risk. The second point speaks to understanding interest rate impact. And I started with the fact that there are some economic indicators, or factors or variables that we need to always understand, and ask ourselves, how will this impact, my portfolio? How will this impact my own investment, even as an individual or as an investor managing his or her own portfolio? So being able to understand interest rate impact is very critical, and it helps you to be able to deal with some of the volatilities that we see. For bond investment, for instance, the interest rate changes affect bond prices. As asset managers, some of us have taken position in the bonds market about 4 years ago when rates were very low. Treasury bill at a point got to as low as 1% or even less than 1%. 3-year, 5-year bond got so low as 3%, 4%, 5%, and some of us will have taken position in that. But now, in a rising interest rate environment, you can agree with me that some of those bonds or those investments are already, below or under the water. But you are forced to carry them or hold them to maturity, or probably even exit and take the loss. But understanding how interest rate impacts your portfolio is very critical. When interest rates rise, the bond price would typically fall. So there's an inverse relationship. As rates are rising now, the prices of those bonds are falling. When the price of those bonds are falling, it means that when you now want to sell those bonds, you are basically going to sell them at a loss. However, for short duration bonds, because they tend to mature quicker, in the rising interest rate environment, is much preferable to invest because your interest rate risk is basically minimal. But in a rising interest rate environment like ours, if you're buying bonds of 20 years, very long duration, your risk is higher than for a short duration bond. For dividend stocks, for high dividend paying stocks, they are more attractive in a low interest rate environment, while growth stocks tend to benefit when interest rates are low due to cheaper borrowing. So we can see that play out in the equities market today. For high dividend paying stocks, some of those stocks in the banking sector, consumer goods, and the other key sectors where the dividend yield is usually high, they are usually very attractive in a low interest rate environment, relative to growth stock. And then the floating rate bond. So basically now when you're advising, when you want to borrow, it's advisable to even borrow, based on a floating rate structure, such that, by the time rates are declining, you are able to reprice, in the same line. But if you fix your rates right now at the current high yield, what that means is that when you start trending down or start trending down, you are stuck with that high rate that you're paying because that instrument was issued in a high interest rate environment, or that borrowing was done in a high interest rate environment. And then also interest rate sensitivity, is also important. This also speaks to understanding the interest rate. Understand duration. Duration basically means the length of time that you're holding that instrument, or the length of time that instrument is being issued for. So be aware of the duration of your bond holding, as it measures how sensitive they are to interest rate changes. Like I said, a long duration bond, or a bond that is issued for 20 years or 10 years or relatively long period of time, they are more sensitive to interest rate changes. And so they increase the risk, that you hold as an investor holding that particular instrument. And then inflation-proof investment, we are currently in the high inflation environment, but there are instruments that we can invest in that protect us against inflation. One of those instruments is real estate. Real estate and other alternative or commodity-backed investment or instruments are a good hedge against inflation, since they are able to rise in value in an inflationary environment. So somebody who holds a real estate property, definitely, your rent will tend to increase. A lot of landlords are already issuing letters for increase in rent. The value of that property itself, also tend to increase, with inflation. So inflation basically helps, investment opportunities that are in the real estate or commodity-backed opportunities relative to other traditional investment. We also have some investment in certain sectors within the equities market that are also inflation-proof. Why? Because they are able to pass on that high cost, to the end users with minimal impact, to their ability to sell. So stocks in sectors like, consumer staples, utilities, and healthcare, tend to perform well during inflationary times. And this is largely because, the product and the services that they offer, people will always need it, and whether the economy is good or bad, people will always go to the hospital. In short, you have more people in the hospital or demanding healthcare products, when the economy is bad, relative to others. So there are certain sectors that are also inflation-proof, so those sectors also should be considered and looked at within the context of your portfolio. And then we also have monitoring economic indicators. It's very critical to put an eye on some of these indicators. At the beginning of the year, relative to what we have now, some of these parameters were not where they are today. Interest rate, even the FX rate, inflation, they were not where they are today. So being able to pay attention and monitor these key indicators, as a portfolio manager or asset manager or an investment professional or a treasurer in the corporate institution is critical, because it can provide insights into the trends that may likely happen and also help you to manage or mitigate against certain potential volatility that will happen. So at the beginning of the year, imagine FX at 1,000 or slightly below, and people took positions relative to what we currently have here, or even interest rate not as high as what it was. So the equities market was doing significantly well between January and probably halfway into February. And so with the direction or outlook of rate increase, a lot of people will decide to exit the market and position themselves, for the fixed income market, just to take advantage of those rising interest rates. So being able to pay attention to these economic indicators is very critical for managing a portfolio in a volatile market. And then also hedging strategies. I know some of the hedging instruments, may not necessarily be so active within our market, but they're also key to pay attention to. Things like options and futures and derivatives are good hedge opportunities in a market like this to be able to reduce, the losses. I've talked about the fact that real estate is also a good inflation proof investment. Is also a good hedging tool. So invest in assets like real estate to be able to hedge against rising prices, and then also investing in dividend paying stocks. So some of these things can be used as a hedge, in addition to derivative options and futures, to be able to reduce the impact of, volatility in the portfolio. And then we also have technical analysis that helps us to understand prices, the trends of those prices, and also market sentiment. These things we also bring in, to guide us. So look for patterns such as support and resistance level to make that investment decisions, or whether to buy or to sell. So it gives you a good insight or overview of how the market is panning out, over a period of time. So those patterns tell you, okay, is this an opportunity to buy? Is there an opportunity to exit? So understanding the use of technical analysis is also very critical. Some of these might look like for sophisticated investors or portfolio managers, but I think that, they are relatively easy to understand, and they can be applied in a time like this. Risk management is very critical in a market like this that we operate in. We have things like stop loss. Sometimes those stop loss policies are there for organizations, but they don't monitor, they don't follow through, but in a time like this, it helps you to reduce the amount of loss that you incur on your portfolio. So set stop loss orders to automatically sell those assets when they fall below a certain price, and then it helps to also prevent asset losses. Also limit your exposure to any one investment. I said earlier that concentration is a bigger risk in a volatile market. It is important to diversify, but even in diversifying, you need to also set risk management parameters, that helps you to minimize and mitigate the amount of loss that your portfolio is exposed to. And then also invest in defensive stocks. So there are stocks that are, they're able to withstand, certain uncertainty, certain volatility, in the economy. So let's pay attention to some of those defensive assets, within our domestic market, also on a global scale, those safe haven assets that, can help us create a balance in our portfolio is critical in a time like this. Sometimes the return may not necessarily be, as competitive as what is obtainable in some other instrument, but they give a good cushion and a good balance, for the portfolio that we create. And then it's also important to rebalance regularly. This is very critical. In a volatile market, it's not enough to create a portfolio, and then go to sleep. Regular review of the portfolio and rebalancing is critical. Adjust the portfolio for risk tolerance. Review your portfolio to ensure that your investments are aligned with your risk tolerance, especially in response to changing market conditions. So this is also very critical. And more critical also is what rebalancing does for you is that it helps you take advantage of, market corrections. So you see that, you're exposed or you are below in a certain percentage or indicator that you have created, or you have gone massively above, it helps you to, realign, and readjust. So rebalancing during market corrections can offer opportunities to buy undervalued assets, and sell overvalued assets, enhancing your long-term growth potential. So this is also very critical to rebalance regularly, and also being able to use that as an opportunity to identify some of the opportunities within that volatile market. There are distressed assets, that are looking for buyer. People are looking to cash out simply because they want to hold cash. And so they are willing to sell at cheaper pricing and levels. So rebalancing your portfolio gives you the opportunity to be able to take advantage of opportunities like that. And then when even those opportunities exist within your portfolio, sometimes it's better to cut your loss and move on. So those decisions you can make basically by, regular review of your portfolio, to ensure that, you are more aligned with current market realities. And then also understand your risk tolerance. Risk tolerance is very critical, and a lot of the time we really don't understand what our risk tolerance level is, both as individuals and also as, a fund manager or portfolio manager or one managing corporate investment. But at a time like this, you need to be able to understand what is your risk tolerance level, what is your trigger, and risk tolerance is also very personal. It's personal for individuals. It's also personal for a corporate. So it's like wearing a agbada that doesn't fit. If you go and carry the risk tolerance of somebody, it's like wearing a cloth that doesn't fit you. So it's always important for you to understand what is your own risk tolerance level. And you can do that with self-assessment to determine how comfortable are you with market fluctuations and market volatilities. At what point can you not take it? At what point are you willing to cut your losses? So those things, you can get from having a good understanding of your risk tolerance level. And if it's something you can't do on a self personal level, you can consult a financial advisor to walk you through. A financial advisor can basically help you to assess what your risk tolerance level is. And it's critical because it's an independent person. Sometimes you're doing it yourself. You might want to, there's that bias, that overconfidence bias that might set in, but an independent person looking through and helping you assess your risk tolerance level, can be a good option and can help you, create a more tailored investment strategies that can guide you going forward. And then lastly, I'll talk about emotional discipline. And, in a volatile market, there are two things that you basically see, fear and greed are two emotions that tend to play out, and those two emotions are not positive emotions. So people tend to be afraid and then they sell off, they rush to sell off. People tend to be greedy and then they tend to hold on when they should be selling. So it's important in a volatile market, to be emotionally disciplined, and, for you to be emotionally disciplined, you also need to understand what your risk tolerance level is, and you need to be financially informed, so you avoid reacting impulsively to short-term market movements. You are emotionally discipline and balance to be able to know when to take a decision, and that the investment decision I'm taking now, is not a function of fear, or is not a function of greed. Sometimes we've accumulated, significant amount of gain, but we are saying, oh no, the price will still go up, and things like that. And then you lose out before you know, market has tumbled. But you knew that at that point in time, you even breached, your target price for exit. But greed, setting, and then at the end of the day, you lose out. So in a volatile market like the one we currently operate in, is important for us to be emotionally disciplined. It's important for us to avoid the emotion of fear and the emotion of greed. And it's important for us to be able to develop a disciplined investment approach by sticking to, the plan that we have set. In making an investment decision, there is an analysis that is done, and there is a plan in place. That plan also involves setting target of, when I'm exit target, if it's equities, or even looking at, asset allocation, a certain percentage of asset allocation to a certain asset class. It's important for us to be able to be disciplined enough to ensure that we stick to this plan, whether in a volatile market or not. It's important for us to stick to this plan. And when you do that, you tend to minimize, unnecessary losses, in quotes, that come as a result of emotional decision, that we tend to play in or bring into our decision making. So I think this is the last slide. So thank you very much for listening. And over to you, Wale.
Yes, thank you so much for that comprehensive overview. I mean, so much to unpack in that very insightful presentation you just made. More so towards the end, which now focuses really on what we are discussing today, which is how do you navigate volatility? Thank you so much for those practical advice that you offered. So we're going to now move on to the panel conversation. And this is the point where everyone attending will also have the opportunity to chime in with your comments and questions. So again, I want to remind you all to please use the Q&A field when you do so, and not the comment field, so they don't get lost. And I think we're already seeing some questions already flowing out of naturally from the presentation itself. So we're going to unpack them as we proceed. But before that, I have the pleasure of introducing our panelists, and I'll do that very quickly now. First, I have Ola Oladele, who is a financial expert. She has great experience spanning treasury and fixed income trading. And she founded oladele.com, a social enterprise focused on bridging Africa's financial education gap. But beyond that, Ola is also the executive producer of The Money With Show, a podcast promoting personal finance literacy. Her impact includes launching Nigeria's first treasury bills investment app and successful bond issues. It's a pleasure to have you, Ola, for joining them today.
Thank you for having me.
Also joining Ola is Tony Odutola. Tony is a Deputy Chief Investment Officer at FCMB Pensions Limited. He has 2 decades of experience in fund management and investment research, and he's a seasoned financial professional with global education credentials. And he has held leadership roles in major financial institutions and is recognized for his expertise in private equity and portfolio management. It's a pleasure to have you, Tony.
Thank you very much for having me, Wale. Thank you for the introduction.
Not least, we have Chukwudi Nwaokeke. He has very deep banking experience. He's a banking professional with over 20 years of experience, specializing in fixed income trading. Indeed, he is. That is his portfolio at Coronation Securities. He has led treasury departments at multiple organizations, contributing to their growth through his vast expertise in interest rate and treasury bills trading. Chukwudi, it's a pleasure to have you join us too.
Thank you, Wale, for having me here.
And then, of course, Odiri will also be joining this panel session. and she will be taking many of the questions that some of our participants have already posed following her presentation. So we are talking about volatility. It's a real thing impacting us as investors in Nigeria today. When you think about the macro issues, inflation, exchange rate volatility, it can be quite devastating when you are caught on the wrong side of many of these trends. So hopefully our panelists will be able to do justice to guide us all on how to make better informed decisions when investing. Now, quite often at events like this, there's a lot of talk about giving specific investment recommendations. But what we really want to focus on today is how do I navigate volatility? And of course, that would include recommendations, no doubt. But that is what I'm hoping that we'll all take away from this interaction. So let me pose my first question, maybe to Audrey, following her presentation. How should investors prioritize between short-term and long-term strategies, given the fluctuations that we're seeing right now in interest rates and inflation? So perhaps you can speak specifically to that, because that is a real thing. That is some real volatility that we're seeing right now.
All right, thank you very much, Wally, for that question. So how should investors prioritize short-term or long-term? Sorry.
Yes, between short-term and long-term.
All right. So I think I will just give from the perspective of being an asset manager, but also from my own personal investment experience and what I think. What we've seen this year with the rising interest rates, puts a challenge on the disposable income of everybody. Individual corporate entities are spending more, so not enough is available for investment. Individuals are having to spend more, not enough is available for investment. But however, this is also an opportunity for people to begin to be more intentional about investing, and not just investing on the long term, on the short term, but also investing for the long term. Like today, we have bonds that are trading at 20, 21%. You have a 5-7 year bond trading at that level. What that means for an investor is that you're earning 20%, or you have the capacity to earn 20% for a much longer period of time. Now, if you look at 1-year treasury bill, 1-year treasury bill is probably trading at a yield of maybe 23%. And so somebody will look at it and say, oh, 23% is higher than 20%. But don't forget that in 1 year's time, that treasury bill will mature. And if we're not careful, you are thrown into a declining interest rate environment. And so you are faced with a higher reinvestment risk of putting that matured money in 1 year's time in a lower yielding instrument. So what I would say is critical to diversify, and more important, I would say, is if you are generating income consistently, I think we should begin to look at more of our portfolio tinted towards long-term instruments, particularly if those funds are long-term funds. You don't need them within a short period of time. So a major part of it should not be skewed towards longer-term instruments, such that you can earn 20%, 21%, even 22%, depending, for that longer period of time. And then if I were to give a certain percentage, I would say maybe 60-40, 60%, now push that to long-term, buy bonds, invest in good equity stocks that are paying good dividend. A lot of those, even at the interim dividends we see from the equities market, a lot of them are becoming very attractive. And what is driving this attraction is largely, the banking recapitalization and the fact that the retained earnings will not be used, as part, will not form part of the capital. So a lot of these banks are now forced to push it out, to the investors, and they are pushing it out as dividend. So it's a good, and because these stocks are not are trading fairly well relative to where it would have been if not for the rising interest rate environment. It's also a good opportunity for people to take position at these levels right now, such that by the time the market switches, such that interest rate starts declining, more money begins to flow into the equities market, and you now begin to see that traction. But the focus really is on the dividend yield that will likely crystallize, as a lot of these banks over the years are now paying more of their money, to investors. So I would say on a portfolio allocation, I would say probably 60 in long term, 40 in short term, provided that those long-term investments are backed by long-term funds, funds that you probably don't need for a long period of time. Thank you.
Thank you for that. Spoken like a real analyst, which of course we know you have that background. Okay, so let me move now to, I think I'll go to Ola. Again, trying to get a sense of markers, things that can guide us. What key indicators do you recommend for investors to continue to monitor closely to anticipate shifts in market volatility? I imagine that you might speak to some of the macro indicators, but perhaps there are other things that you found to be useful.
Yes, thank you. Thank you once more for inviting me. I'm really glad to be here. So thinking that the audience here is people that are trying to understand and get their feet on the ground when it comes to investing. And I'm not talking to research analysts. So I'll try and keep it simple, right? Sure. So there are some little markers that we all see that are basis for major decisions. One of them is inflation. Generally, when you see inflation going up, when you see exchange rates unstable, when you see that they're saying the GDP is negative month and quarter on quarter for a period, what generally tends to happen is that the central bank is forced to respond to those things, meaning they can't allow inflation to go off the roof, or they can't allow FX or the Naira to get to 10,000. They will be forced to respond. So in that response, that's what causes the market volatility that you see. So when, for example, the central bank takes up interest rates, what happens is that money becomes more expensive. You make more money from taking less risk, meaning that if I give the federal government my 1 Naira, I will get 20%. But why am I in this stock? So what you find is that people will sell their stocks and go to federal government. That's when you hear things like crowding out and things like that. So when you also see that GDP is beginning to fall and they start saying, oh, there's a recession. What is a recession? Consecutive negative GDP growth. What is GDP? Is sum of all our activities. At some point, when GDP goes low for so long, the central bank has to come back and say, I need to ginger the economy. What are the things that they do? They drop interest rates. What am I trying to explain here? Market volatility doesn't just come. It is driven by factors, and it's driven by things that we can see around us, such that as an investor, if you can see that FX is still going on a roll, you know that there's less of a chance for interest rates to start coming down. Why? Because they are still trying to defend the currency, you know? And then when you begin to see that, for example, economic growth numbers are not good, or maybe economic numbers are getting better, like you've seen in America, and you see employment numbers are coming out good, then you can now see that they will drop interest rates. So just little things that we see, and they are simple: inflation, FX, economic growth. If you stick to those, they sort of reflect other bigger things that a research analyst will be looking at, right? So if you say money supply will end up showing up in inflation numbers. So as a layman, if you look at where inflation is, you can get an idea of the problems of the central bank, and you can get an idea of how they'll be thinking to respond to it.
Thank you very much. Spoken like a true podcaster. Really appreciate how you simplified all those terms for everyone. Okay, let me now go to Tony. Now, Tony, let's move out of the realm of what I can describe as traditional investing. Traditional investment strategies, would you say that in this volatile, well, I'm not necessarily go out, but I'm probably just giving you something to think about. But would you say that traditional investment strategies still work in today's volatile environment, or must we now focus a lot more on alternative approaches towards investing and hopefully reaping the benefits of that? What are your thoughts?
Okay, thank you very much, Willie, and good afternoon to our viewers and listeners. I'm happy to be here. I think that the base for answering this has been laid by during, in our presentation. I mean, the question is, do we, still do traditional in this volatile environment, or we take, alternative? I remember in our presentation, she sort of touched on having our feet sort of across the various asset classes. So the short answer would be yes. Traditional investment strategies absolutely still have a place into this volatile environment. And I think it's fair to say that there's a need to have that adapted, core principles like diversification, asset allocation, like, Odira has mentioned. They remain like, the focus on those will give you long-term value, which of course is crucial in terms of uncertainty. Equities, bonds, and all of that, will still play that foundational role. And the idea is, do not put your eggs in one basket. And that, of course, remains timeless. However, given the speed and complexity that, of the market changes that we see today, alternative approaches then become more relevant. I think Ola has mentioned something around your real asset like real estate. In times like this, having a bit more value, it then makes sense to say you need to include those asset classes in what you're doing. So real estate, private equity, and hedge funds, and more so because they are not as volatile. So they help you, create some form of stability within your portfolio. I know that some of the people listening to us are retail investors. So the question would be, how
do they get access?
Exactly, because the entry point for those kind of investment are high. But you would find that there are certain funds that allow you access to this sort of investment without necessarily, getting it as a whole. So you'd be a part owner of some, some investment like that. So yes, while traditional strategies still work, blending them with alternative approaches can have flexibility and provide opportunities for investment. So it's basically say, not abandoning the old, and to be able to evolve and create a more robust portfolio by having a mix of both of them.
And I think if we take a look at how well those traditional markets have performed this year, I think there's still a case that you still want to be in there. Interest rates are high, so we're seeing interest. Let me go to Chukwudi now, and we want to tap into your great wealth of experience over the years in fixed income trading. What would be your advice to investors in terms of managing liquidity risk? Because there's always a temptation to look for the higher yielding instrument, but that potentially could manifest as higher liquidity risk. Well, from your experience, what can you tell us?
Thank you once again. I would say usually the higher the risk, the higher the gains in such an investment. But at this point, I think at the end of the day, like everyone else has said, I think diversification is key in this high interest regime that we are currently experiencing. Over the years, it's common knowledge that, look, while rates are getting higher, but or rather, the way things are right now, we have high interest rates across board. However, I think people should actually now look at portfolio management more now. You diversify, invest in bonds, invest as well. It's not enough money for you. The other state for that at any point in time. No, I said that that's the way to go. I think that's the way we should all go at this point.
Right. Okay. Chukwudi, your audio was breaking up a little bit towards the end there, but I think we got the meat of your message. Hopefully it gets clearer as we continue. But wasn't that bad. All right. So I want to take a few of the questions in the Q&A field. Again, I want to encourage people to continue to send them in. And I also want to appeal to our panelists to be as concise as possible when they respond so that we can get through as many of them as possible. So before I chime in with more of my questions, I want to take some, and the first one will be from James. So he speaking to Audrey's presentation, and he says that the emphasis is quite heavy on market instruments, overview, and reviews. But he wants to know, how can volatility be properly managed in unpredictable environments like ours? I think towards the end, you certainly got to that. So maybe that question was asked earlier. But do you want to add anything to what you have said in your presentation?
Not really, just to redirect the question to the last 3 slides,
yes,
which speaks
I think
to
so. I think that
the strategies to navigate. Yes.
Right.
Thank you. But if I can just reemphasize some of the points, number one is basically diversification. In a market like this, concentration risk is the biggest risk. And then look at understand the direction of interest rate and how it impacts on your portfolio. We also talked about risk management. So those are the strategies that we've highlighted, and we can always share the slides also so that people can have access to it.
I'm sure they will appreciate that very much. Thank you for that. Okay. The next question from Oluwole says, with respect to dividend stocks, it appears that there is no difference between high-paying stocks and high-rising stocks when it comes to a low interest rate regime. Would you agree? In other words, somebody wants to find out if we agree with that sentiment, that there is no difference between a high-paying, dividend-paying stock and a high-rising stock. Does anyone want to speak to that point? I think that it's really speaking to the two ways you can make returns from investing in stocks, right? Either dividend or capital appreciation. I mean, there is difference fundamentally, but does anyone want to speak?
No, I agree with you. Oh, sorry, Ola, go on. Go on.
Okay. So, one thing I just want to highlight here is that you can't make a ballpark statement, because when you just say stocks, there are different stocks performing differently based on different events and different sectors and stuff. But then I would also say that generally in a low interest rate environment, generally, that's just being general. It's not speaking to your stock selection. In a low interest rate environment, stocks generally tend to do well. Why? Because if I'm getting 1% on in fixed income or in treasury bills, and a stock is going to give me maybe capital gains of 10% or 7%, in comparison, I'll go for the stock. So I would say that I won't use that as a rule, because it will not apply to each and every stock. But yes, there's a case for the fact that when interest rates are low, stocks generally tend to do better.
Thank you for that. But I think he was also trying to get a sense between whether or not what's the disconnection between the two types of return. And I think fundamentally they are different.
Okay, let me speak to that. So there are some stocks, there's a stock in the Nigerian market that is like maybe 700, 800, right now. And then they pay 30 Naira in dividend. If you do that return, that's maybe like 5%, right-ish. But there are other stocks that pay dividend and they are at 20 Naira and they pay 2 Naira 50 kobo. They are 25 Naira and they'll give you 10%, right? They are both dividend paying stock, but in terms of actual return, in terms of the return rate, one is doing better than the other. And we'll find that there are those kind of things, such that there is no direct correlation. It still boils down to each individual stock. It also boils down to the sector when it comes to the fact that will a stock, if a company gives you capital gain, will automatically give you good dividend returns. It's not direct. You have to look at the stock to know the particular nature of that company.
Right. So which is why I said fundamentally those types of returns are different. So you need to look at the individual situation, like you said.
Exactly.
Thank you for that. There is a question about options, because Audrey mentioned that, and someone wants to know, do all brokers allow investors to trade options? Where can one find information about options trading on the NGX? I do know that hasn't taken off just yet, but it's one of those things in the pipeline. But does anybody have any updates on that?
Like you said, I think derivative is something that the NGX is working on. It has not gone mainstream, so it's still not yet open to the public. But I think that, there's still, some sort of how will it play out. So they're just working with a few capital market operators just to see how it will play out before they open it to become mainstream.
Thank you for that. Okay, but I do have some other questions, and let's talk a bit about the geopolitical situation and the risks playing out globally. How do these influence market volatility? Because the world always has a way of presenting one or the other. And the thing about these things is that we never really know when they will happen and to what extent they may escalate. So does anyone want to speak to how those things can potentially signal volatility and how one can potentially react to those things? Because quite often they are not, there are events happening thousands of miles away, but potentially they could impact your investments here. Anyone want to chime in? Maybe Tony.
Maybe I got to take a shot at it. I mean, global geopolitical risk, plays a significant role in markets volatility. One quick example is the war in Ukraine and how that has affected, global logistics and food prices, especially grains, because around that space, you have about 40% of the grains markets being controlled. So the event around there that has, effects across the entire world. And you can probably say that's where the global inflation issues late, this present one, started off from. Also events in the US, which largely becomes the core for the entire world. And in terms of inflation growth around there, how that spirals into everything that we do. So pretty much the idea is to be not to be oblivious of those events and how they can impact what we do. And so as much as possible to stay proactive rather than reactive. So again, what then comes to play here is, again, diversification, because that's pretty much your first line of defense against these shocks when they occur. And as they spread, you're able to then adjust. Staying informed is crucial. Like I said, and understanding what those are, and not to make impulsive decisions, if you like, because again, volatility. When those things occur, they then cause short-term volatility, which may not be there for too long. So the decisions do not necessarily need to be impulsive. To be able to understand those better, which is the reason that you need an analyst to be able to analyze that properly. So rather than investors go and take decisions themselves, to come to players in the market to be able to predict that properly. And of course, with a well-diversified portfolio, we can then weather the storm.
I think the last point you made is so important because analysts are perhaps in a better position to understand the linkages and the implications of events. I mean, we're thinking about what's happening in the Middle East now. I think many years ago, it will automatically lead to, in my opinion, a much more significant rise in the oil price, but perhaps the market conditions have changed and it's not as significant as they used to be. So it's so important to speak to analysts so they can give you very valuable insight. There is a question.
Yeah, Wale, just to
Sure,
add a quick one to that, you just raised a very important part of the geopolitical problems that could affect markets and the volatility. And that Middle East crisis is a major case in point. Like you said, it usually leads to expected rise in crude oil prices. It's still not uh, totally to be left out right now because I think it will still affect if there's a full-blown and outright war in the Middle East. I think it will affect prices. And then how does that affect us back here in Nigeria? We know we are generally a petrol-based economy. We are import dependent on our fuel, and that's a major problem that we are going to face. If prices rise, if prices of crude rises in the market, what then it's how does it affect us? Then we expect fuel prices to also rise in Nigeria because there's a direct correlation between crude prices rising and then our prices here. And that's a major factor. And like Tony said, speak to your dealer, your broker, your analyst before you take any decision because they are in the front line and are easier to analyze the market and will better explain to you in the long run.
Absolutely. And I mean, I'm not an oil sector analyst, but at least I'm very aware that the dynamics in terms of where production is across the world is so much more diversified today than it was even as much as 15 years ago. So the impact of disruption in the Middle East, I think, is less severe than it was a few years ago. And that was actually the point I was trying to make. And if someone was caught in the past, they would just continue to think that, this thing is going to go up 40%, 50%, but it may not necessarily be the case anymore. But thank you for those comments. No, I think there's a great question here because we've spoken a bit about diversification, and commodity is something that many people tend to look at. And of course, precious metals as well is part of that thinking. So someone is asking about gold. Being domiciled in Nigeria, how do you invest in gold stocks? You mentioned ETFs earlier, Odiri, but I was wondering what kind of avenues are available.
All right. So gold is probably one of the what we call a defensive asset or instrument that you can invest in, as a way to hedge against inflation and things like that. However, I know within Nigeria, a lot of the transactions or activities around gold are still more private. There are still a lot of private investment and transactions. For public opportunities, I know we have one gold ETF listed, a gold mutual fund ETF, that is listed also. I'm not sure we have any firm trading gold exchange, but I think the starting point really is to let's even explore the gold ETF. What is it doing? I know about 3 years ago or around that COVID time, there was a lot of investment going into that particular fund. But I think maybe people were basically chasing return because at that time interest rates was really low, and a lot of people were chasing return, and so they moved towards gold and other things. But I think right now, from what I see on the trend, it's a bit more quiet.
Right.
But we can start from that. But I think outside Nigeria, in other global market, it's a big asset class that has a robust structure around it, that people can make such investments. But within Nigeria, I think the structure is really not so robust and clear. But I think also whoever asks this question, you can engage with your investment or financial advisor. They can give you a list of those opportunities, whether those ones within the country, if there are any, those outside, or even the private opportunities for gold investment that are available. But I will always say, that, because investment has some level of risk attached to it and some level of advisory attached to it, it's also always important to ensure that, whatever outlet you're engaging with is one that is registered with the SEC, such that if you have issues at the end of the day, you have a robust regulator that you can make a complaint to, and then they can make that investment. So thank you.
Right. So being protected is so important. Thank you for making that point and emphasizing it. Thank you. I want Ola to pick this one up. You did mention defensive assets earlier, Odiri, but Ola, maybe you can be more specific because someone wants to know rather, what defensive assets can you be specific on? Give us some examples.
Okay, so that you understand what defensive assets are, they are basically assets that will keep doing well regardless of what's happening in the economy. And to identify around you, what are the things that regardless of what is going wrong or right, people will still spend money on. In Nigeria right now, you will still have to buy food. So things around that, they are defensive assets, things around that food economy, and anything that is listed on the exchange that's around that food economy, it's a clue generally that they will do well. I dare say that in this 2024 world, telecoms is also a defensive asset.
Okay.
Right? Transport, logistics, things around that. Things around
What about
production.
energy? I was thinking,
Energy, exactly. I was getting
because
to
even
energy.
though the price is now 1,000, people
Yeah.
will still have to
Real
buy
estate.
Hola,
fuel, right?
hola,
Exactly.
property,
Real
real
estate.
estate,
So I was getting to real
real
estate.
estate.
Now,
Yeah.
the thing is, can generally say property, but sometimes you have to look at the things that are supporting that industry.
Yeah.
For example, you might not be able to buy a house or two, but you can buy a cement stock. That will be a defensive asset, because as long as people keep building houses, there will always be demand for for cement and the things that are related to it. So I try not to name names, but I would say that if you use that logic, you will know the things around you that are defensive, and then you find stocks in that space and invest in them.
Thank you very much. I think that was very useful to share so that people get a good sense of, where can I get the best protection in the market today? Thanks for that. All right. Again, I want to encourage our audience to continue to keep your questions coming. We're going to try and take as many of them as possible. Okay, let me look in again to get a few more. Okay. There are some questions about the slides. Okay, so someone wants Audrey to speak on this. Audrey, I'm aware that real estate investment is high risk, and you just mentioned that it is a hedge against inflation in your presentation. Would you advise long-term investments in this?
All right, thank you very much for that question. First of all, I'll say real estate investment is and should be a long-term investment. Real estate is not something that you are speculating on or you're investing for the short term, because first of all, it's very illiquid. It to a large extent requires a certain large amount of capital. So you can definitely buy property today and in 1 month's time you say you want to sell. You can, but it will definitely take a long time. So it's not like going to the exchange and in 3 days you're able to sell your stock and get your money. That's not for real estate. So when you are deploying capital to real estate, always put at the back of your mind, if it's an investment, that this is long term, because we have people who deal on real estate, as a form of trading, more like they buy, they fix it up, they sell. But the time to sell is usually a longer period of time. It's not something that you can flip, particularly in our market today, it's not something that you can flip, within a short period of time. So generally, real estate is a long-term investment opportunity. It's also a good hedge against inflation, largely because, imagine if you bought property 2 years ago at, let's say, 50 million or 20 million. That property today, in this environment, will definitely not be selling for 20 million. It can be selling for even double that or even triple that. And we've seen that across, even as even land, not even something with structure, even a land, can appreciate faster, in a rising interest rate environment. So when we say it's a good hedge, it means that you can buy it and keep it and hold it, for a long period of time. And then when you want to sell, you realize that, you're selling for value that is ×5 or ×10 or ×3 or ×2 or what you initially bought it for. But it's a long-term investment instrument. Thank you.
All right. Thank you for that. Very valuable insight into that. I want to go to Tony now. Someone is asking about insurance of your investment portfolio. Is there any insurance policy against market volatility? Is that product out there that we can buy? Or is it a case of just adding derivatives and, of course, the diversification? I wonder if anyone has created that product that I can buy to insure my portfolio. Have you found it, Tony?
I mean, it will be nice if
it would be nice for your pensions portfolio, right?
it will be nice to have that. And because we don't have that certainty, is why all through this conversation there's been that advice to spread as much as possible across asset classes.
That is your insurance, the diversification, essentially.
Yes, yes. Diversification is your first, level of insurance. I mean, in the pension space, for instance, capital preservation is my first, primary objective,
Priority.
right? And what that then means is, as much as possible, you will not lose value. And the
Right.
only way to then do that is spread them across. Like Ola had mentioned, Odi has also alluded to, at any point in time, you have one market doing very well, you have the other market suffering for it. So you having adequate representation in those markets then means that at the end of the day, you are sort of insured against the losses. Your returns may not be fantastic.
I think they balance out. That is the insurance. So if one goes up, another goes down. On average, hopefully, you are in good place.
So that's the insurance.
Understood. No, great point. Great point. Chukwudi, I want to come to you because speaking about diversification, there's been a lot more focus on foreign currency denominated fixed income instruments. And I was wondering if you could chime in on that as an opportunity in this.
Sorry, I didn't hear you. You froze
I was saying
the second.
Foreign currency denominated fixed income.
Yes.
I wanted you to speak to that as an alternative for those who are looking to diversify their portfolio. Maybe you can just comment in general about the trends you're seeing there and the sensibility of going into that.
Thank you. Very good question, actually. So we're basically talking about Euro bonds here. So these are fixed income securities, just like regular FGM bonds. However, they're denominated in dollars and not naira. So you have the FGN bond, which is local and denominated in naira, while we have the euro bonds. So those that issue euro bonds basically are the federal government and corporate institutions in Nigeria, the banks, some of the banks, and then the federal government of Nigeria. So there's this line that we always use. We say dollar is king, and we know the reason why. So the dollar at the moment is doing far better than the naira. It's not an ideal situation, but it's the situation that we are in as a country. So is your money safer? It's as safe as it is in naira as it is also in dollars. So, but basically, some clients prefer to invest in euro bonds, having their investment denominated in dollars. So right now, there's a lot of interest there because most people just convert their naira and then prefer to fix in bonds, especially the way in euro bonds, especially with the way we've seen the fluctuations in the FX market. So most
the
people
yields
just
also
the yields are not bad at all. So right now the yields are not bad. The coupons on them on some of those bonds are actually very good. So we've seen people gravitate towards the euro bond space, and it's actually doing well. The sovereigns are doing well, and then we also have the corporates doing well as well.
Right. Okay, so it's certainly something to look at.
And it keys into the level of diversification that we've all been singing here today. So, you spread your risk. You have some denominated in euro bonds, in the local bonds, treasury bills, CPs as well.
Right.
That diversification is key right now. So it helps you and, helps your portfolio at this point in time.
No doubt. And I think, just like you've just reiterated, the point about diversification should be a key message that I think most attendees should take away from this interaction today. Diversification is a discipline of investing that we must not get away from. No matter how intoxicating it is to make a lot of money when things are going up, it can be very devastating when they start going down. So you want to make sure that you are somewhere in the middle of that volatility. And that's why you need to buy this and buy that and not just put all your eggs in one basket. Now, a very important point, I think, about emotional management, because I've just talked about that. When the markets are going up, there's that herd mentality. You can't lose. Everybody feels, things are wonderful. And then, of course, when they go down, we we've seen over the years that it can be very, very devastating. So how do we get that emotional management that Audrey spoke to? And Ola, I was hoping you could comment on this, because this should
Ola,
really...
maybe before Ola answers, let me just remind her of sometime in the market way back in the day, if she remembers, when the CBN had issued bills at they were selling bills at about I think about 10%, and then at one particular auction they just went all the way up, and we were all left in the as it was a terrible period for most. She remembers. That's why she's laughing. So she remembers. So before you go
Yes.
on, just remember that part.
Yeah.
Yeah.
So I mean, what Chukwudi is talking about.
So sorry to, before you respond, I really, what I'm hoping you would speak to is in a
The
practical way. How
Yeah.
can I
Yes.
get that,
Yes. Yes.
manage those emotions, even if it means that I have to take away some direct responsibility, and so that way I don't do what I shouldn't do.
So I mean, just anchoring on the story that Chikudi just gave the story. Now, what literally happened was that we're all happy in one direction. Then something happened, market volatility, and it carried us to a new arena, right? Now, what are the emotions? First is loss. The fact that you have a loss in front of you, and the fact that it looks like it's all doom and gloom, right? The first thing you might do is panic and sell. Or this other thing for some people is they keep believing, right, that it will get better.
Optimism.
Right? Those are emotional.
Irrational or rational,
Yes.
as the case may be.
Right? So what I always say, and what we have learned over times as a former trader, is that you have to go back to logic. After you've run through the emotions, and the best way to do that is to have a conversation with someone, right? Because if you stay within yourself, emotions will take you over, and that's the fact. We are human. So the first thing is to have a conversation with someone who is less emotionally engaged with that event. And what are you asking? What really is the problem? Is this permanent? Is this temporary? If it is temporary, then it just means I should wait. I should wait it out. If it is permanent, then I need to be thinking about cutting my losses, which is something that we talked about. Sometimes you just have to cut your losses.
But it can also be on the way up. So let's talk about that too. So
yes,
it's not,
and
always
that's
be a
on the
loss
flip
situation.
side. But usually when it comes to making money, it's a better situation. Where the problems really are is when there's a loss situation.
That is what's more critical.
Could end up losing your whole shirt off. Yes. So is it permanent? Even when you're making money, is this event temporary or is it permanent? If it is permanent, then you should wait. But if it's temporary, even though you can see ×3, don't be waiting for ×4 exits, right? The major thing here is that understand that we are human, and those emotions would always show themselves. The question is, how do you balance yourself out by getting past the emotions and looking at the logic and the information in front of you? A simple example that we might relate with is the pandemic. During the pandemic, all stocks went down. Whether the company was doing well, whether the company, whatever it was, every stock price came down. Now, because I had been in the markets before then, why are they selling? Is this thing going to last forever? Are there companies that will thrive in this? How about buying them? Because if you see a telecoms company and you know that everybody's buying data and the stock price is down, why would you not buy? But people stayed up because of fear. And in the end, it panned out like that because those stock prices were low because of general market. However, those companies did very well in that financial year.
Right.
And then people started coming back. But those who entered I hope I was able to answer the question effectively in a relatable way.
I think you certainly did. Thank you. But I want Tony to still chime in on this point. Ola focused on the dynamics of when the market is going down. But I think there's also an important dynamic when the market is going up, because you may be buying at the peak and then your losses will meet you in the future. So maybe from your experience as an investor, I know certainly in an organization like yours, there will be a discipline around an investment committee. Mm-hmm.
It's usually a word on the street that has the, that follows the head mentality, and everyone goes, right? Behind that is the greater fool's theory, meaning somebody else is coming, to buy out what somebody else has made, gains out of, and at some point there will be a tipping point. Now, this then goes back to the conversation around, what has your analyst told you? Have you consulted your analyst? Now, these guys have gone to school, they've had experiences, they understand certain things. So informations like EE, informations like CIR, informations like, sorry, I'm throwing jargons now, but those are the things that the analyst will check to say, does this thing not look overpriced? However, if you have as much knowledge as, being able to look at those things, and pretty much you can just say, based on what is being sent to you, you can do within an industry, what is the price earning ratio, and compare them. One will shoot up, one will be down, one will be around the average. Those should be indicators to tell you it is time to get out. Again, on the flip side, it should also tell you it's time to get in. But again, the truth about it is there are certain indicators out there that should tell. If you are able to know how to, identify them, good. If not, just talk to your broker. You want to do this, is it the right thing to do? Your broker, has a duty to help you make money, because that would then make you come back next time so that you can also then make money. So there's some symbiotic relationship going on there. So, you just understand that even in a period where it is rising, especially for traditional instruments, even the ones that are not traditional, the information out there that talks about real estate prices are really high at the moment. Again, if you're going to talk to your realtors and all of that around the period, understand. Then there's some level of impact that the macroeconomy has on it as well. So you need to understand, is there so much money in the system? Those such things, they're a bit technical, but are the things that would then help to be able to know whether or not it is time to get out or stay in there and enjoy the ride. Whether it is a local investment or a foreign investment, where people are talking about NVIDIA, is it overpriced? Is it, things like that. But ultimately, those indicators are there if you're able to spot them.
So what I hear you say is check with analysts. What are the analysts saying? Even though some people will argue that some analysts too can be emotional, but that's a conversation for another day.
And that's why I said comparison then helps. So look at them across the industry.
Okay, so not just one.
What is this saying? In fact, even the indicators for the companies themselves. So this guy is doing 2x. This guy is doing 1x. Why is this guy doing 2x? Is it a corporate governance issue? Those are some of the things that you can ask questions about. Answers you get that are rational will then tell you whether or not you should stay in there or get out.
But I think there are some other factors as well, beyond what we can call the fundamentals are telling us about assets. I think there's some external factors. So liquidity, I think, from my experience, is one. If for example, because of policy, liquidity dries up from an investor base, say foreign investors, what would the impact on the market? Because the reason prices go up and down is because of demand and supply. So if foreign investors all of a sudden, for example, pull out, just as an example, that could trigger some dynamics that are not necessarily based on fundamentals, but could have short, medium, long-term implications for assets. So, Audrey, maybe you can share your experience as well on this point. Very briefly, please.
All right. Okay, so I think the first thing for us to look at is what is the mix of foreign investors and local investors at this point in time? I know there was a time when the market was driven solely by foreign investors, but I think that we've been able to achieve some level of moderation and diversification from the impact of foreign investors. We have the likes of the pension industry also becoming a major player in the market. We have individual investors also rising up to the occasion. So I'll say that is still a risk, but I think the risk is now minimal, relative to what we had before when foreign investors were a significant player in the market. Now I think, if it's not a 50-50, it's more a 60 in favor of local or domestic investor relative to foreign investors. So the risk is now being minimized relative to what we used to have before.
Right. No, I hear you. I hear you on that. I wasn't speaking particularly on that point. I was just saying that beyond what we can call fundamentals, there could be some other dynamics that could influence asset values. But Ola, do you want to chime in?
Yeah, I wanted to add something that, that liquidity is also part of the fundamentals.
Yeah.
Right?
Yes.
Also bearing in mind that maybe one stock has 10 million units. They've done bonus shares over and over. And then one, they've kept with the same number of units, right? So you will find that stock will be more volatile because there are many people playing around with it. But it's still fundamentals. But it is fun. That's why an analyst will help you say, this stock will move more than this in this environment. Those are the things that make difference, but they are still fundamentals somehow or the other.
I hear you on that. Even though I hear you on that, even though the point you're making about liquidity is a bit different from the one I was making. You're talking about the liquidity of the asset. I'm talking about
liquidity from outside, from investors.
Either look internal, external. I mean, for example, I'm sure Chukwudi will appreciate this whole issue about FAC. Whenever FAC comes in, there's some dynamics in terms of what happens, yields, and so forth. So that's the point I'm making. And we see that play out as well, even in equity markets. So that was just the point. All right. There is another question here about, is it advisable to sell stocks even when the stock starts appreciating after many years of losses? So this again is the whole discipline issue. So the stock price has been going down. It has stayed down for a while. But I think this person is probably stuck in that position where he is hoping it will go up. So what will be the logical way to approach a situation like this? That's not to say that he may be wrong, but what will be the logical way? So we let us be this person's investment committee. Who wants to go?
Okay, so I could the first thing I would say, right? I will be quick. The first thing I would say is why did you go into that stock, number one? Why did the price of the stock go down? If, for example, there was a company in Germany a year or two ago that they discovered that all their books had been cooked for a number of years and the stock price just kept going down. You see, if you hear that kind of news, you're supposed to jump ship immediately. That's the fact. Why? Because it ended up going to zero. Because if there's something fundamental about that company that is keeping stock prices down, you should know why, and you should know whether you should be exiting or not. Now, that's on one side. Another thing is that, are you getting cash flows? Are you getting dividend? Because the dividend should also be used to offset what you are calling a loss if you decide you want to exit. That's another. Then thirdly, where is the company going in the future? If the company is not selling you a future you can buy, then you should actually exit. Cut your loss, reinvest it in something else and exit. If you look at it from this example, let's say you bought the stock 5 years ago and you started considering selling it 2 years ago. Right. Think of if you put that money in USD 2 years ago, where would it be right now? Think of if you bought bonds with it 2 years ago, or maybe let's say last year, where would it be right now? Right. So those are the kind of decisions that you need to be need to consider.
But if I can just add something to this, because I just picked up something else here. I'm not sure if it's the same person, but someone is saying, is it advisable to sell stocks when the stocks start appreciating, even after many years of losses?
I think that was the question the person asked initially. So he bought the stocks a few years ago.
They've come down.
Then it dropped. But
Now they
now
are going
it's come
up.
out
Should I
of
now sell or should I hold
it
it?
has crossed his
Right.
buy level. Should he now sell? And I understand where Ola is coming from.
I think I even know this.
Yeah, so so I understand where she's coming from. So at this point in time, what should the person do? And you listed the things the person should consider. And I think my advice would be: you waited this long, just come in the money, exit, and enjoy the fruit of your wait.
is that but
Depends
is
on
that
the
always the
future
best
story.
decision?
Depends on the
Behavioral
future.
finance.
I
Depends
think
on the future.
I think that
No,
everything should
Ola,
be assessed
yeah,
in
you
the
already give
moment.
the background to the decision he could
Nobody.
Yeah.
make. And I'm saying, if you had this patience for so long, so why don't you enjoy the fruits of your patience
No,
and
but
then
I think it's
exit?
all about opportunity cost. What are you going to do if you sell? So if
Mm,
if
mm.
the if the if the if it's the story is still positive, I think you always have to look at the moment and say, what are my options vis-a-vis my objective? If the analysts, like Tony was suggesting, are saying this company still has good prospects, then I think even though you have endured a lot of pain over the years, maybe there's more prosperity in your future and you should hold it. So I think the discipline really should be assessing assets for what they are vis-a-vis your objectives.
Yeah.
I wonder if anybody else wants
Only,
to.
or maybe the person could do something else, sell part of it and reinvest in another stock
That
while
is
you hold on,
possible.
and
But
while you
again,
hold
the
on
question
to some
is
of it. If
opportunity
it's
cost.
positive,
If you sell it,
yes.
what are you going to do?
Maybe look for
But I
a
guess this is a
stock
good
that you
time.
could
Fixed income
invest.
is great. So you might as well
Yeah,
just
you might
cash in.
just come to Coronation Securities, and then we'll
Indeed.
give you the
Indeed.
advice that you need.
Yeah.
Got you. Tony, did you want to say something? Sorry, I think I interrupted you.
No. I mean, it's been captured. I was just going to say that part time. I mean, all I've talked about it. Detach yourself first from the activity, reassess the situation, and say, if I was coming in afresh today, would I bring money?
Got you.
So meaning that you are looking at what is happening today and what does the future hold. So again, detach yourself, whether it is a loss-making position or it's a profit-making position. Detach yourself and say, from today going into the future, if I had fresh money, would I put it in here? And that should help.
All right. Okay. Now, specifics now, as we begin to round up, somebody's asking about Guinness. Perhaps this is the last one I'll be able to take. Guinness shares have been disappointing, and now the company has been acquired by another company. What are the risks? Is there an opportunity that the shares can still do well? So this is a real life situation about a change in the dynamics of a company. Does anyone want to take a stab at this particular case? Silence.
Okay, so
All right.
I'll take the first shot.
Okay,
Okay.
please go ahead.
So I mean, it's the question is not done too well, and it's being taken over now. Is there still, prospect? Again, it's not done too well for certain reasons. I think some are related to foreign exchange liabilities and all of that. And then the fact that parent company isn't putting in, fresh funds. So like we just mentioned in the last question we created, you need to take a look at who is buying, what are the antecedents, what synergy, if any, can be brought in, and then what the outlook will be. There's also the possibility that it could be delisted. Those are the options you then put into the pots. And then again, if you do not know how to look at it, talk to people who have got the experience and expertise to say, what do you see here? If it's going to be taken over by that new company or that new owner, there's a likelihood that it will be taken at a profit, or at a premium, rather. Should you just wait and enjoy that before you go? If you think that they do not have value that they want to add, then maybe like Chukudi said, jump ship and look for elsewhere to put the money. That was my take on it.
Right. I think, Audrey, did you want to say something? Really quick, if you can.
No. Okay. So I think you have said majority of what I wanted to say, but I think the fundamental really is, why did we go into that investment in the first instance? It's always important to look at it vis-a-vis our investment objective, and also to review the fundamentals. Sometimes the story or the narrative might instigate some emotional response, but it's always important to check on the fundamentals so that at the end of the day, you are not selling too quickly and losing out or on the benefit, because regret is something that we see a lot play out in the equities market. Oh, I should have waited, if I just held on,
Vision.
Yeah. So understanding the fundamentals and checking relative to your investment objective is also very critical, in addition to what Tony has already said.
All right. Maybe I'll give Ola the final word. Anything else to add as we begin to round up this interaction, which I think has been quite useful?
Yes, I really must say that it has been a really good conversation. I would like to highlight the fact that emotions are very important, especially as retail investors. And it's important to be aware and to know when your emotions are driving you, whether it's the thought of making extra money that makes you lose objectivity, or is the emotions of loss that makes you still lose the same objectivity but with different expression. Exactly. So I would say, as retail investors, market volatility is what makes you make money. If you enter at 10 naira and it stays at 10 naira and nothing is happening, how would you say you made capital gains, right? So as against thinking market volatility is something that you need to insure away, I would say that you should think more around how do you understand things enough for you to navigate it profitably. I am an ex-trader, so that I can tell you for free that you won't make money every day, all day. But if you solve properly all the time, you would see that you actually end up making money. You would understand better. Now, as a financial educator now, I always say education and baby steps. Meaning learn and take action. No matter what we tell you, if you don't buy that stock, you would never really understand what we are saying. But I'm also not saying go and use all your money to learn investing 101. But I'm saying start with baby steps, see different cycles over time, and begin to build confidence. But staying on the sideline, inflation will have you for lunch. And if you go to the other side, and you jump in on all the risk, you will still lose money. So just that middle ground, taking it step by step and understanding that you are still making money, right? You are not at the end of your career. I believe that there's still life ahead of us. So don't act like it's a finite event. So understand you're going to keep making money and you keep making adjustments as you go.
Thank you very much, Ola. And thank you so much to our panelists and, of course, to our keynote speaker, and to Coronation for helping to make all of this very enlightening conversations possible. Certainly from the interaction that we've had in the Q&A field, this has been useful. So thank you so much. And I think on that note, I would hand over to Azizat Awonuga, who is Team Lead Products and Trading at Coronation Securities. She'll be delivering some closing remarks and thanks. So over to you, Azizat.
Thank you so much. Good afternoon, everyone. My name is Aziza. I'm the Team Lead Product and Trading at Coronation Securities Limited. And as we bring this session to a close, I'd like to express our heartfelt appreciation to everyone that joined me today. Your engagement, your questions, and contributions made this webinar a truly valuable experience. In today's ever-changing financial landscape, understanding how to navigate the volatility in the market is very critical. We trust that the knowledge shared today will empower you to make informed investment decisions and meet this challenging time. I'd like to extend a special thanks to our keynote speaker, Odiri Ogini, the MD CEO of United Capital Asset Management, for delivering a compelling and in-depth presentation on how to optimize investment during these volatile times. Your expert insights on market shifts, inflation trends, and global financial events have certainly expanded our understanding of how to strategically position our portfolio for the future. I also wish to thank our distinguished panelists, Tony Odutola, who is the Deputy CIO for FCA Pensions Limited, Ola Volatility, founder Money Week Club, and Chukwudi Unwokeke, the head of fixed income trading and Coronation Securities Limited. Your discussion and expertise on interest rate, inflation management, just basically wealth management has added immense value to today's session. A big thank you to our moderator, Wole Amberwa, for steering the conversation with great skill and ensuring that every segment remained engaging and informative. Lastly, I would like to express gratitude to the Chief Executive Officer at Coronation Securities Limited, for setting the context with his insightful opening address. As we conclude, I encourage all of us to continue exploring ways to optimize our investment portfolio and stay ahead in this dynamic market. Together, we can weather the storms of the market volatility with the right strategies. Once again, thank you all for being part of this webinar. We look forward to more opportunities to connect, learn, and grow together in future. Have a wonderful day ahead. Thank you.
Thank you very much, Azizat. And thank you again to Coronation Securities for facilitating this interaction today. I do believe it has been very valuable to everyone that's participated. And many thanks again to the panelists and speakers for making it all worthwhile. On that note, I want to say thank you again to everyone, and we look forward to having you at the next event.
Thank you.
Thank you. Bye.
Thank you.
Bye.
Bye.
Bye.